Hello and welcome to our latest edition of BCR Webcasting. I'm delighted to be joined today by Anil Walia, who is Director of Supply Chain Finance, EMEA at Deutsche Bank. And Anil will be speaking at our Supply Chain Finance Summit on the 26th of April. So this discussion today with Anil is about that topic, or aspects of that topic, and we will be giving you more details about his presentation at the end of this session. Anil, welcome to BCR Webcasting.
Thank you, Michael.
And thank you for joining us. This is, a very, very topical subject, of course, the whole area of ESG, and there is, of course, great incentives for corporates and their suppliers to be part of these ESG programs. And I want to ask you about that. And my first question, in fact, is about the EU taxonomies. As I understand it, the primary objective of these taxonomies is to redirect capital flows towards more sustainable business activities. I mean, how would you describe the current position on EU taxonomy for these sustainable activities?
Hi, Michael. You started off exactly on the core of the whole issue over here. EU taxonomy and the EU Green Deal is setting up rules for primarily investment in activities that the EU has as part of the taxonomy defined as sustainable, and the Green Deal is setting up the strategy of how to move in that particular direction. So it is a good thing to start with. It's a huge effort. The initial EU taxonomy document is 550 pages and it's growing, is my understanding. The idea is, however, that it is trying to create a standard by which everybody can move in one particular direction. And I think that's a great way to start. To start on this one. If you remember, supply chain finance 15 years ago, you and I have been talking about this for such a long time. At a point in time where there were no standards, and with no standards being in place, the supply chain finance business has had its ups and downs. I think as we move into the sustainable part of our economy and the world business in itself, this is going to be a big step. Of course, it needs to be adopted globally, but at the risk of repeating myself, it is a great first step.
So clearly it seems to be working well, because as we discussed just before we started the session, anecdotally at least, we've seen some evidence of very large increases in volumes in supply chain finance through the banks. So how are banks actually going about supporting corporates to develop these SCF programs for sustainability?
So I think it is relatively early times. 2 years ago, I probably had one or two sustainable supply chain finance related discussions, in a year. At the moment, I am in the middle of implementing, if I may say so, five such transactions. It just shows the exponential growth in the interest in this one. Banks are expected at this point of time to be the thought leaders when it comes to setting up robust sustainable supply chain finance programs. There have been a few sustainable programs out there, but without a market standard or even without a market practice, the questions may be raised on the structures of those transactions. So one of the challenges that the banks are having are to be able to create something that is robust, and I don't even want to take the word greenwashing over here. So I use the term robust. So supply chain finance programs or sustainability linked supply chain finance programs that are robust over the next 3 to 4 years as market practices, and then finally, hopefully, market standards are established. So we'll be looked at to provide guidance at that level. So within our own team, we, at Deutsche Bank, we have a group sustainability team, and then we have a client solutions team for ESG. Within, within these teams and working with them, we are even talking to procurement on what is a standard KPI within the physical procurement world. I mean, for a retailer, it's going to be different from that of a white goods manufacturer, for instance. So we are having detailed discussion at those levels. The supply chain finance program in itself is follows from the KPIs that the procurement will set up within their physical procurement activities and in their interactions with their suppliers. So the discussion goes much deeper than let's take a supply chain finance program and convert it into a sustainable supply chain finance program.
I mean, clearly this is all still quite new. Growth is rapid, and we're still in stages of evolution with these programs, I guess. With that in mind, what have been the main sort of challenges that you've identified in putting these programs together, maybe marketing the programs as well, having that understanding with the corporates of the benefits and the incentives? What have you seen to be the main challenges?
So even if you look at a company who has a global sustainability program in place, or a sustainability strategy rather in place, there are so many effects that are coming through, and there are so many activities that are involved in this particular space. Typically, a company is looking at their scope 1 sustainability activities, which is the scope of anything that has to do with, let's just take carbon dioxide or carbon emissions, what is indirectly in their control. Supply chain finance, and the scope 3, which refers to carbon emissions in the counterparts who are not in direct control of the company. So your suppliers, your client, your client, for instance. So this is part of a growth journey. Supply chain finance is coming somewhere in the middle of this one. So it's scope 1, what can we change ourselves? And then let's look at how we can start affecting the behavior of our suppliers. But as we know, or as research shows, 80% of the carbon emissions are in the supply chain. So affecting changes within the supply chain or affecting improvements at the ESG level in the supply chain has a major leverage effect on the global ESG score of a company in itself. That is being slowly recognized. It's a process that we're going through.
And what about costs that are attached to this? I mean, presumably there are significant costs attached for the banks offering the supply chain finance, significant costs for the corporates, and significant costs for the suppliers. Can you just explain a little bit about those 3 areas and give us an idea of where the costs are and maybe an idea of what they are, perhaps?
So within a supply chain finance environment, the players are the buyer, the suppliers, and the financing bank, or a fintech if there is one. Within a sustainability linked supply chain finance program, an additional player comes in, and that is the ESG scoring agency. We do need to recognize, however, that the ESG scoring agency is not coming in for the supply chain finance. The ESG scoring agency is coming in because of the KPIs that are there within the procurement. So a typical set of KPIs would mean it could be the carbon footprint, it could be human rights, it could, or it could be in sustainability in the terms of palm oil, for instance. So there are different layers of that. A corporate, the procurement department will mandate an ESG rating agency to provide ratings or ESG ratings to their suppliers so that they can first take a call, is this a supplier or I want to work with? Take an example, companies will have a no tolerance policy against human rights, right? So if a supplier gets a bad rating on the human rights, then the procurement has to take a pretty quick call on whether they want to work with that particular supplier, right? So this cost is there as part of the ESG strategy of the company in itself. So when it comes to setting up a sustainability linked supply chain finance program or converting an existing supply chain finance program into a sustainability linked supply chain finance program, there are no incremental costs to the costs that have already been taken over by the company in getting ratings for their suppliers, because the financing company will take the ESG rate scores of the suppliers and will set up in its simplest form, will set up a differential pricing table where a greener supplier with a better ESG rating will have a more preferential discount margin for discounting his invoices. Mm-hmm. So therein lies a bit of the cost element, okay? And if we are going to look at a situation where let me just use the colors, red, orange, yellow, and green. It's easiest, right? So, a red supplier, ideally, he should be paying more than the average, and a green supplier and a yellow supplier should be paying lower than the average. However, if the procurement does not want to disrupt in the first instance its relationships with the suppliers, at a very nascent stage that sustainability linked supply chain finance programs are, there are possible structures where a red supplier pays a particular price, but there is no penalty in the price, whereas a green supplier is paying a much lower price, and there is a incentive in that price. So he's pretty he's being charged lower than that. I believe as things move on, there will be a little bit of a balance out there, so that a bank, if I have an average pricing of 70 basis points on a particular program, how do we balance it, or how much of the cost of giving incentives to the greener or the better rated suppliers is taken over by the bank, and how much of it is compensated within the overall structure. These are structural things. I would not consider them a cost at this point in time.
Okay, so there's a big...
But to be consistent with some of the statements I made at the webinar earlier, we see this as a situation that will move, to a fair distribution of the margins, but to push the business, to bring it into the limelight and to bring it out into the market, we are willing to take in reduction in certain cases of the margins for the green supplier, so that we can create that differentiated table of pricing, which would then be the hallmark of a sustainable supply chain finance program, which is, to take a definition or to sort of formulate a definition, it's a sustainable supply chain finance program is one where the suppliers are being incentivized to improve their sustainability behavior or their ESG scores.
Sure, being incentivized through pricing.
Yeah.
Okay, and in that vein, just sort of leading off from that, what about credit ratings for corporates and suppliers, perhaps. To what extent can credit ratings be affected by ESG ratings? Significantly, presumably.
In the medium term, yes, but to the best of my knowledge at this point of time, I have not seen credit ratings being affected or a credit ratings taking into account an ESG score of a particular client.
Do you think that's likely to remain the case in the future?
No, it will change. It has to change because at the moment, the funding costs of any funding organization are not linked to the type or the ESG. Is not linked to the ESG score of that particular transaction. So whether we are funding a sustainable supply chain finance program or indeed a loan or a guarantee or whatever, versus a normal non-ESG linked funding or a loan program, we are taking that cost onto ourselves. There is at the moment no market-based benefit or incentive for that just yet. But I guess as part of the whole EU taxonomy, as part of the whole Green Deal, as part of the fact that there are investors out there who are willing to take lower margins on their investments, in an if the investment is a green investment of any sort, I think we will get there at some point in time.
It makes sense, doesn't it, really? Because if you have two, let's say, very similar suppliers supplying very similar products to a large corporate, but one is red rated according to use your scale, and one is green, the costs for the red supplier are going to be significantly higher than the green supplier. Therefore, that ought to have some kind of impact on their credit rating, I would have thought.
Yes, but the cost is being created through a second layer of measuring the client. One is his credit rating, and the second is the ESG rating. But you're touching on a topic which is quite touchy at the moment, because when we talk about incentives, right? So you want to incentivize a red supplier. You don't want to dump a red supplier. The idea is to improve the overall average rating of the portfolio, right? So you want to incentivize the red supplier to improve his sustainability behavior or his ESG score. Now that will possibly involve a cost for him to redo some of his processes or his activities. A sustainable supply chain finance program, by putting in a higher price to it, is indeed charging him more. And that is a discussion that we are having with a lot of these corporates, a lot of the corporates who are looking at improving the sustainability in their supply chain along with the banks. That is a discussion that we are having with some of our clients to see how we can balance it out. So the supplier needs to know you're red, so there is a disadvantage to it. So there is an incentive to improve your rating, and we will, or we should be, providing you support in improving that. So there are various discussions out there in the market. There is no market standard or market practice in place. It could be, for instance, spending money or helping those particular set of suppliers with training to improve, to help them improve some of their processes. I know there is, in the agricultural field, there is a little bit of this happening where some of the suppliers are being, farmers are being taught how to optimize the use of water or optimize the use of fertilizer and seeds in their activities. So this is something which has to grow as part of the, let me call it the Green Deal, right? It's not just enough to create a situation where you are being penalized or you are being incentivized because of your ESG link. The idea is, like I said in that loosely framed definition, the idea is to incentivize, to create a movement towards the green. So there are this other aspect. So thanks for that question.
Sure. Okay. And Anil, at the Supply Chain Finance Summit which is on the 26th of April, you're going to be giving us the details of a case study. So we're very much looking forward to that. What are the presumably some of the things we've talked about today will come out in that case study. What are you hoping to be the main points in that case study? Is there anything else that you're going to be covering in the case study that we haven't talked about today? And why do you see this as an important session in the summit?
I think one of the issues that what I'd like to, or I will be addressing over there is the whole infrastructure that is required to analyze and supervise the ratings, because you know in a typical supply chain finance program you're talking about from 150 to 500 suppliers and even more. So you are looking at not just pulling down the ratings from from the rating agency, but also being able to make sure that there is the rules that you've agreed upon with group sustainability within the organization, the rules that you've agreed on with the suppliers and with the buyers are being followed. So this is an independent layer to the sustainable, to managing a standard supply chain finance program, because one of the first things, the word I'm not supposed to mention, greenwashing. We don't have any market practices, right? So I believe where we are at the moment, we are creating the first footsteps towards moving towards market standards, and we want to make sure that anything that we're doing will be robust and will stand the test of time in 2 years' time when certain standards are in place or the rules of the game start changing, which will definitely happen. So it's really about discipline, and it's about teaching the suppliers. And then, of course, we're looking at how we can not only provide a financial incentive, but together with the client also provide, maybe use the word training, to the suppliers who need it. So you enter more and more into the real world of procurement and buying and selling and nuts and bolts, and not just the finance element of it.
We will very much look forward to it, Anil. So Anil Walia, thank you very much for your time today. And just to remind, Anil will be at our Supply Chain Finance Summit on the 26th of April in London. You can get more details about that event on our website, which is at bcrpub.com/events. Thank you very much.
Thank you, Michael. It's a pleasure.